Hello everybody, thank you for joining me. This is Michael Carroll for Business 201. We're going over cash flows. So this is some extra cash flow problems that are not on the study guide, but we'll go through them anyway. So this first problem that we'll do is from the slides from Professor McCarthy. And we'll just be going through that, and we'll be going through a little bit of a harder one next. So here's the last page of the study guide. I put down all the steps that I go through to complete a cash flow statement. Obviously, the TAs teach it a different way, and the professor teaches it a different way. You know, everyone has their own way, but this is the way I do it. So hopefully you can pick up on the way I do it, or just do it the way the TAs do it. Okay, let me forget to start over. Hello everybody, thank you for joining me. This is Michael Carroll for Business 201. We're going over some cash flow problems. These problems are not on the study guide. These are just extra problems that we can go over. This first one is the problem from Professor McCarthy's slides. We'll just be going through that. So on the last page of the study guide for PASS, I put together this list of steps that I go through to complete the cash flow statement. Obviously, I do it a different way than the TAs. The TAs do it through T accounts. I do it through journal entries. But either way you do it, you should get the same answer. So, hopefully doing it a different way doesn't confuse you too much. But we'll see. Okay, so we'll start off. Step one is to put net income into our cash flow statement. Here's our income statement, here's our balance sheet, and two pieces of extra information. Our net income comes from the income statement. We've got a net income of $15. That's step one. Step two is to do these GLAD accounts, gains, losses, amortization expense, and depreciation expense. So we're going to add our depreciation, amortization, and losses, and we're going to subtract our gains. So we look to the income statement for that. We've got depreciation expense, and we've got a gain. No losses, no amortization. So we add both of these. Depreciation expense, 40. I'm sorry, I said we add both of these. We just add depreciation expense, and we subtract the gain. Remember, this cash flow statement is a cash T account. So anything on the debit side increases cash, anything on the credit decreases cash. So we're adding net income, adding depreciation, subtracting the gain. If we had a loss, we would also have it on the debit side, and if we had amortization expense, we would also have it on the debit side. So that's step two. Step three is to go through the information, create journal entries, and flag the accounts that are affected. So here's our only two pieces of extra information. Number one, we sold a building. So we're getting cash of $65, debit cash, debit accumulated depreciation for $20, and credit the building for $80. That means we have a gain to balance this out of $5. So that's number one. Number two, we've got a building. We purchased a building, so we're debiting building for $160. And credit cash. And we also are recording depreciation expense for $30. Accumulated depreciation on the building for $30. There we go. There's our two journal entries. And now we'll go through the journal entries and flag the accounts that are being affected. Besides cash, we'll skip cash. Accumulated depreciation on the building. That's up there in the balance sheet. We've got a gain of $5. That's right there in the income statement. We've got a building that's up there in the balance sheet. Again, we have a building, so we'll mark down number 2. Cash, we skip cash. Depreciation expense is here in the income statement, and accumulated depreciation on the building is also being flagged. There we go. That's step 3. Step 4 is to calculate the debit and credit changes in the balance sheet. So, zoom in on the balance sheet a little bit. We've got cash. Pay attention to the dates. We've got 2016 on the right side, 2017 on the left side. So we started at 100, ended at 120. That's a $20 increase, and it's a debit. Accounts receivable started at 50, ended at 40. So we decreased accounts receivable by 10. That's a credit. Inventory, we increased by 5. Lands, there's no change. Buildings, we increased by 80, so that's a debit of 80. Accumulated depreciation, we started at negative 20, increased to negative 30, so we increased it by 10. That's a credit. Remember, accumulated depreciation increases with a credit, unlike most assets that increase with a debit. So equipment, there's no change. Accumulated depreciation on the equipment started at negative 10, increased to negative 20. That's an increase of 10 again. Accounts payable, we started at 20, increased to 60. That's a credit of 40. Remember, these are liabilities, so liabilities and equity, so an increase is a credit. Bonds payable increased by 5. Common stock increased by 20. Retained earnings increased by 10. There we go. So, and a good check is to make sure your credits equal your debits. And it looks like 10, 20, 30, 70, 90, 105. Looks like they equal. So that is step 4. We calculated the debit credit changes in the balance sheet. Now to step 5, which is the meat of this problem. We're going to start filling in the cash flow statement using these numbers. So if it's a debit here, we're going to put it as a credit on the cash flow statement. So cash, we've got a debit of 20. That's what we're trying to figure out in the cash flow. So we skip 20, or we skip cash. We'll start with accounts receivable. I'd like to do the operating section first, so we're just going to look at our current assets and current liabilities first. So accounts receivable is a current asset. We got a credit of 10. That means we'll have a debit of 10. And the title will be a change in accounts receivable. This delta, or this triangle, represents change, so change in accounts receivable. We're good with accounts receivable. Inventory is a current asset. We've got a debit of 5, so we'll have a credit of 5. Change in inventory. We're good with inventory. Land is a long-term asset. We'll skip that. Go down to our current liabilities. Accounts payable. A credit of 40, so we'll have a debit of 40. Change in accounts payable. There we go. And that's all of our current liabilities and current assets. So we can figure out our operating income. We add our debits, subtract our credits. So we'll do 15 plus 40 plus 10 plus 40 minus 5 is $95. Income from operations. There's our subtotal, 95. You can say income from, probably more, what Wiley says is income provided, so I'll cross that off. Income provided by operations. If it was a credit, it would have been income used from operations. Since this is positive 95, it's provided. Okay, we'll go into our investing section, which includes long-term assets. So land is a long-term asset. Land had no change, so we don't have to do anything with it. The building, why did I not mark it? Okay, I realize I did something wrong already. So if we jump back, I'm sorry about this, if we jump back to step 3, when we did the journal entries, we have a building here, and I accidentally marked equipment, and I should have marked the building on the balance sheet. Sorry about that. Let's see, did I do anything else wrong? Yes, I did this wrong. That should be the building as well. So in number 1, it's talking about the building. I should have marked the building. I accidentally marked equipment. Same thing with number 2. So there we go. Okay, not too big of a problem. So the building, we increased by 80, a debit of 80. So you would think we would credit 80 on the cash flow, but we won't do that because we've got some supplemental information that is occurring, which might complicate something. So we're looking at the building. It's being affected in 1 and 2, which is true. So we'll start with 1. In journal entry number 1, we're going to look at only cash. So how much did cash increase or decrease? Well, in this case, cash increased by 65. We sold the building here, and we got $65 in cash. Since we're debiting cash here, we will debit cash on the cash flow statement. And our title will be sold a building. We can no longer just say change in building. We have to be a little bit more specific in our investing section and in our financing section. So we have to literally say what we did. So in this case, we sold a building. That's our title. So we can cross cash off because we've already dealt with it. So that was number 1. Number 2, the cash being affected is a credit of $160. We're spending $160. So we'll credit the cash flow statement. And our title will be something like we bought a building, or purchased a building. There we go. We can cross cash out on the journal entry. Now, getting back to this balance sheet, it's saying that the building is increasing in total by 80. Now, we can go through these journal entries and figure out why the building is increasing by 80. In number 1, we're decreasing the building by 80, and in number 2, we're increasing the building by 160. So for increasing by 160, decreasing by 80, that means in total we're increasing a building, or the building account, by 80. So cross those off. That explains why the building is increasing by 80. Moving on to accumulated depreciation. We got a credit of 10, so you'd think we'd have a debit of 10 here, but we have some extra information we marked down from number 1 and 2. And here's 1 and 2, the only ones. We've already dealt with cash, so we no longer have to touch the cash flow statements with accumulated depreciation. But we can try to explain why accumulated depreciation on the building is increasing by 10. So, in this case, this is on the building. I should be more specific. Accumulated depreciation on the building. We're decreasing it by 20, and down here we're increasing it by 30. So if we're increasing by 30, decreasing by 20, that's a net increase of 10, which is exactly what our balance sheet shows. So since we've figured out where this balance sheet number is, we can cross it off and move on. Let's go to this equipment. So the equipment, there was no change. So we're lucky there. We don't have to do anything dealing with the equipment. Accumulated depreciation on the equipment. We've got a credit of 10. And now this is kind of where, even though we didn't mark it, we're still not going to debit 10 because we've already how do I explain this? We've already included it in this depreciation expense pretty much. We've already accounted for this 10 some way. So accumulated depreciation is increasing by 10, even though there's no supplemental information here. How you can think to yourself, how did accumulated depreciation on the equipment increase by 10? Well, the most likely answer would have been, we'll call this number 3. We would have debited depreciation expense by 10. We would have credited accumulated depreciation on the equipment by 10 as well. So a credit of accumulated depreciation by 10 explains this accumulated depreciation here. And we can also say, okay, we've got depreciation expense of 10, depreciation expense of 30, which combined, that's an expense of $40 for depreciation. And that's exactly what our income statement shows. And that's exactly what we put in our cash flow too. So we've already accounted for that. Our depreciation expense matches. And we can also knock out this gain. We've got a gain of 5, which is exactly what's on the income statement. We can knock that out. And we've also accounted for it in the cash flow statement. So there we go. We've got, that's all of our long-term assets. So we can calculate our investing section. 65 minus 160, that gives us a credit balance of 95. So this is income used in our investing section. Our financing section is long-term liabilities and equity. Starting with this bond payable, which is long-term, we've got a credit of 5, so we can have a debit of 5. We don't have any extra information associated with that. So a debit of 5, that means we're increasing cash and increasing the bonds payable. So the title would be issuing a bond payable. Again, we can't just say change in bonds payable. We have to be a little bit more specific. We're issuing a bond payable because we're increasing bonds and we're getting cash from it. So there we go. We've completed the bonds. Common stock is increasing by 20, or we've got a credit of 20. So we'll have a debit of 20 here. And just like the bond, that means we're issuing common stock. Retained earnings, we've got a credit of 10. And again, this is kind of where it gets a little confusing. And just when you practice these a lot, you tend to see that there's always something special with retained earnings, and there's always something special with accumulated depreciation. So even though we didn't mark it, there is something special going on in retained earnings because net income and dividends go into retained earnings. So net income we've already accounted for way up top. Now dividends here on the income statement is 5. So retained earnings increases with net income and decreases with dividends. So in total, retained earnings is increasing by 10. And our fact pattern says that net income is 15 and dividends is 5. So retained earnings is increasing by 15 through net income and then decreasing by 5 through dividends. That explains the increase of 10. Now we've already accounted for the 15 in net income. We've only got to account for the dividends of 5. When we're paying dividends, that means we are crediting cash because we're paying cash. We're giving $5 to the shareholders. We're decreasing cash, that's a credit to cash. And our title is something like paid a dividend. So we can explain this retained earnings, increase of 10 through net income and dividends. So that's all of our accounts. We've crossed off everything in our balance sheet, and we've crossed out all of our journal entries. We can figure out our income from financing. We've got 25 and the debit, subtract 5 from the credit. That leaves us with a 20 debit That's income provided by financing. So we'll take all of our three subtotals, add those up. 95 plus 20 minus 95. Remember debits. Add your debits, subtract your credits. That leaves us with $20. Change in cash. And it's a positive number because it's a debit number. And that explains our $20 increase on the balance sheet. To further illustrate this, we can take our beginning cash amount in 2016, which was 100. 100 plus 20 equals 120, which should be our ending cash, which is exactly what our balance sheet shows. So there we go. There's the cash flow statement for question number 1. We can move on to a slightly harder question, but it's not too bad. So pretty much the same setup. We've got a balance sheet, income statement, and extra information. Now we'll just jump right into it. So first step is to put in our net income. Here's our net income on the income statement. And in this problem, I'm just going to get rid of the thousands. I'm just going to put the... I'm just going to get rid of the thousands so it doesn't look so messy. So we've got 148 in net income. There's step 1. Step 2 is to add our depreciation expense, add our amortization, add our losses, and subtract our gains. So we get all that information from our income statement. Here we've got some depreciation expense, and we don't have any amortization, gains, or losses, so we don't have to do anything with that. Add our depreciation of 9, and that's step 2. Step 3 is to go through the supplemental information and record the journal entries. So I'm going to do this on a blank piece of paper so we have extra room. So question 1, or number 1, we've got depreciation expense includes $6,000 for the building and $3,000 for the equipment. So I'm going to debit depreciation expense for $6,000, credit accumulated depreciation on the building for $6,000, and then debit depreciation expense for 3 and accumulated depreciation on the equipment for 3. That's number 1. Number 2, we've got we issued some long-term bonds in exchange for land. So we're buying land for 110, and we issued a bond payable. Number 3, a building was purchased. So we debit building for 120, credit cash for 120. Number 4, pretty much the same thing, but we're buying equipment. Debit equipment for 25, credit cash for 25. Number 5, we issued some common stock cash for 20, and we'll credit common stock for 20. Number 6, company declared and paid dividends. So debit dividends, 29, credit cash. There we go. There's all of our journal entries. And now the next part of this is to go through our journal entries and mark on the balance sheet any of the accounts that are being affected. Besides cash, we can skip cash. So in our first one, we're looking at depreciation expense and these 2 accumulated depreciations. So here's our depreciation expense. We can mark that on the income statement. And the accumulated depreciations, there's one, there's another one. In our second journal entry, we've got a land and a bond payable. So that's number 2, land, and the bonds payable, number 2. Number 3, a billing in cash. So we skip cash. We don't really care about that right now. And we've got a building in number 3. 4, we've got equipment in cash. Skip equipment. That's number 4. Number 5, we've got cash and common stock. So common stock will be marked for number 5. And then number 6, we've got a dividend in cash. So the dividend goes into retained earnings. So we'll mark retained earnings. There we go. We've marked all of our accounts. Step 4 is to calculate the debit and credit changes in the balance sheet. So here's our balance sheet. Zoom in a little bit. We've got cash beginning at 33. Remember, pay attention to the dates, 2016, 2017. Began at 33, ended at 51. So that difference is an increase of 18 as a debit. Okay, accounts receivable started at 30, ended at 20. It's a decrease of 10 as a credit. Inventory increased by 5. Prepaid expenses, that's an asset, increased by 4. Land increased by 90. Buildings increased by 120. Accumulated depreciation started at -5, ended at -11. That's an increase by 6 as a credit. Equipment increased by 25. Accumulated depreciation increased by 3. Remember, it started at -1 and it increased to -4. And accumulated depreciation increases with a credit. Same thing with liabilities. They increase with a credit and equity increases with a credit. Accounts payable increased by, looks like 16, if I'm not mistaken. Increase of 16, that's a credit. Income tax payable decreased by 2. Bonds payable increased by 110. Increase of 20. And an increase of 119. There we go. There's all of our debit and credit changes, and we can move on to step 5, which is taking these numbers that we just calculated and putting them onto the cash flow statement. So we'll start with our operating section, which includes current assets and current liabilities. Here's our current assets. Cash is what we're trying to figure out, so we won't do anything with cash. We'll start with accounts receivable, which is a current asset. We've got a credit of 10 here, so we'll do the opposite on the cash flow. We'll have a debit of 10. And we can do change in accounts receivable. We're good there. Inventory, we've got a debit of 5. So we'll have a credit of 5 here. Change in inventory. There we go, we're good there. Prepaid expense, that's also a current asset. Debit of 4, so we'll have a credit of 4. Change in prepaid expenses. Land is a long-term asset, so we'll skip that. Go to our current liability, account payable, credit of 16, so that's a debit of 16 on the cash flow. Income tax payable, that's also a current liability, debit of 2, so we'll have a credit of 2. Change in income tax payable. There you go. Here, I'll try to zoom out a little bit. So we've got income taxes payable there. So we can cross that off. And that's all of our current assets and liabilities. So we can calculate our operating section. We add all of our debits, subtract our credits. So 148 plus 9 plus 10 plus 16 minus 5 minus 4 minus 2. 172 is our income provided by operations. We're getting positive 172. Next we can do our investing section, which is long-term assets. So starting here, land. Land, we've got a debit of 90, so you'd think we'd have a credit of 90, but we've got some extra information here. So we'll go to journal entry number 2 and see what's happening with cash. In number 2, we've got land and a bonds payable, nothing going on with cash. So in this case, we won't do anything with the cash flow statement. But we can try to explain why the land is increasing by 90. And in this case, it's pretty easy. Just kidding. So, looks like I did my math wrong. We started at 20, ended at 130. That should be an increase of 110. Don't know why I thought it was 90. Sorry about that. 110. So that's probably a good example of why you should just double check, make sure your credits equal your debits. Hopefully that's the only mistake I made, but we'll see. So let's try to explain why land increased by 110. And in this case it's pretty easy because land increased. We've got a debit to land for 110. So since those match, we can cross those off, signifying that we don't have to do anything for the land. Okay, how about for the building? We've got a building debit for 120, so you'd think we'd have a credit of 120, but we've got some extra information here that might change that. So let's go to number 3. The journal entry for number 3, what's happening to cash? Well, cash is decreasing by 120. So that will affect our cash flow statement. We're crediting cash in this journal entry. So we will credit 120 on our cash flow statement. And again, we can't just say change in building. We have to be a little bit more specific. We're looking at journal entry 3. And if you look down here, it says the building was purchased, so we can just say purchased building. There we go. And in our journal entry, we can cross off cash because we have accounted for it. Now the building in our balance sheet is increasing by 120. Now let's try to explain why that's going on. Well, in this case, it's pretty easy as well. The only thing going on with the building and all of these is occurring here. It's increasing by 120. Same thing here. Since they match, we can cross those off. Okay, accumulated depreciation. Accumulated depreciation always has something funky going on with it because it's usually associated with depreciation expense. So we've got a credit of 6, and we have a marking here for number 1. And in number 1, we've got accumulated depreciation increasing by 6. Well, here, let's go through it how we usually do. So accumulated depreciation is increasing by 6. We've got a marking here, so let's go to journal entry number 1, see what's going on with cash. In journal entry 1, there's nothing happening to cash, so nothing has to be done with the cash flow statement. But let's try to explain why accumulated depreciation is increasing by 6 as a credit. And in this case, it's also pretty easy. Accumulated depreciation on the building is being credited by 6, which matches accumulated depreciation on the building, a credit of 6 as well. Moving down, equipment. We've got a little mark here, so we can't just do the simple, debit here, credit here. Possibly. So number 4, what's happening to cash? Well, we're crediting cash by 25, so we'll credit cash here for 25. And same thing as before, we purchased the piece of equipment, and we can mark off our cash there. So you might be thinking, okay, the equipment, we had a debit of 25 here, and we put a credit here for 25, which is what we would have done already. That's true. In this case, it worked out easy, but in some cases, it won't always be like that. And we've already experienced that with the land, right? The land had a debit of 110. We never credited 110 here because the journal entry did not involve cash at all. So that's just a little explanation. Now, going back to the equipment, we've got a debit of 25 here. Let's try to explain that. Well, it's right here in number 4. Equipment has a debit of 25. That explains the equipment account. Okay, going back to accumulated depreciation on the equipment now. We've got a credit of 3. Journal entry number 1. So here's the accumulated depreciation on the equipment. Credit of 3. That explains that. And again, there's no cash involved in this journal entry, so nothing occurs in our cash flow account. Now, since we're on number 1 and we're pretty much done, let's just wrap this up. Depreciation expense of 6 and depreciation expense of 3. That's a total of 9 in depreciation expense, and that's exactly what's going on in our income statement. So we can cross that off. Depreciation expense here, here, here. And we also accounted for it up here with depreciation expense. There we go. So that's our investing section. That's all of our long-term assets, so we can figure out our income from investing, which looks like 145. Income used in the investing section. Now our financing section, which is long-term liabilities and long-term equity. So we've got a bonds payable, that's a long-term liability, a credit of 110, but we won't debit 110 because we might have something going on in number 2. So journal entry number 2, nothing is happening with cash, so we won't do anything on the cash flow statement. But let's try to explain this bonds payable increase of 110. There's the increase, 110. Bonds payable. Pretty easy. Common stock, we've got a credit of 20, but we've got journal entry number 5, so let's look at that. Journal entry number 5, we have cash here, so we'll have to do something with the cash flow statement. We're debiting cash, so we will debit cash here. And our title will be something like issue common stock. We can cross the cash out. And with the common stock, let's try to explain this increase of 20. Well, it's right there. Common stock credit of 120. Cross those 2 out. And finally, retained earnings. A credit of 119. Journal entry number 6. Let's look at that. In journal entry 6, let's look for the cash first. We're spending $29 in cash. A credit to cash, so we will credit cash in our cash flow account. And we're paying dividends. Cross off this cash account. And we've got going back to retained earnings, an increase of 119. Now let's try to explain that. What goes into retained earnings? Net income and dividends. So net income increases retained earnings, dividends decreases retained earnings. Here we've got net income of 148, and we've got dividends of 29. So increasing retained earnings by 148 and decreasing by 29, that's a net increase of 119. So that explains the retained earnings, and this dividend explains part of the retained earnings. And the net income we've accounted for way up top. So there we go. We've got all of our accounts crossed off. We've got all of our journal entries crossed off. So that means we're most likely done. Let's figure out our financing section income. Looks like it's a credit of 9. Income provided, or I'm sorry, income used in financing. There we go. Here's our 3 subtotals. 172. We'll add our debits. 172, subtract our credits, subtract 145, and subtract 9. So that is an increase of 18. That's our change in cash, which is exactly what our balance sheet shows. Cash is increasing by 18. And to further solidify the point, our beginning cash in 2016 was 33. 33 plus $18 should equal 51. And that's our ending cash account, which matches exactly what our balance sheet shows. There we go. Now, an extra thing that I didn't talk about here is that in cash flow statements, in the very bottom, we add some footnotes talking about any non-cash purchases. So in this case, if you can read through the journal entries, we purchased in number 2 a piece of land not using cash. So whenever something like that happens, when we buy land using a note payable or buy a building using a bond payable, something similar to that, we make a mark of that way down at the bottom and say something like we purchased land for $110 using a bond payable, something like that. Okay, so that's our cash flow statement. That's all of the examples we have. This other example here that I was going to go through is on the study guide for the cash flow, or the study guide for the final exam, which is in this same accounting playlist, so you can watch that in the other videos. So thank you for joining me. Hopefully that helps. Good luck studying. Take care.